Coming up on Market to Market, more pushback on global trade deals. The aftermath of a Bakken crude spill fires up political debate. And one dairy blazes its own trail from the bulk tank to the front door. Those stories and market analysis with Don Roose next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. This is the Friday, June 17 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Last month's lackluster economic growth was one of the many factors keeping the Federal Reserve Board from raising interest rates. This week's series of reports are providing more signs there will likely be further delays. Government data showed retail sales numbers for May rose only 0.5% when compared to April's 1.3% jump. When automobile sales come out of the equation, retail sales rose only 0.4%, half of last month's increase. Those sales numbers were hindered by rising costs as the Consumer Price Index bumped up 0.2%. Taking out the swings created by food and fuel, core CPI had a similar increase of 0.2%. As the economy appears to languish, agriculture is benefiting from the recently cheaper dollar through higher prices and increased exports. However, recent agreements forged through the efforts of several U.S. trade representatives are facing ever-declining approval ratings. Peter Tubbs reports.
The debate over ratification of the Trans-Pacific Partnership continued this week. Business and trade groups, including the National Association of Manufacturers and the American Farm Bureau, have thrown their support behind the trade deal, hoping that lowered tariffs would result in higher exports for their members.
Along with tariff reductions and market access gains, the TPP makes important changes to trade rules for agriculture, addressing the non-tariff barriers that reduce trade. The most important of these changes are the commitment to have science-based food safety standards.
The 12-nation treaty, which required 7 years to negotiate, would streamline trade between the Pacific Rim countries. The far-reaching agreement covers not only tariffs, but also financial services, telecommunications, the role of state-owned monopolies, and 24 other topics. The removal of barriers would benefit many American commodities.
Because other Asia-Pacific trade agreements are being negotiated without the United States, we cannot afford, either economically or geopolitically, to walk away from the fastest-growing region in the world.
The agricultural sector is in a position to be a net exporter compared to other parts of the economy. Last year, sales of farm commodities generated a $19 billion trade surplus. The treaty has plenty of detractors that point to more pitfalls than profits. Those lining up to denounce the pact include everyone from drug makers to politicians. Presumptive presidential nominee Hillary Clinton has campaigned against TPP, arguing it will result in a net loss of American jobs, mostly in the manufacturing sector. This puts Clinton in direct opposition to President Obama, whose administration is an advocate of TPP. The pharmaceutical industry is also against the pact, citing a lack of intellectual property protection. And food safety proponents object to a reduction of inspection requirements, as well as language that could define food labels as trade barriers. No date has been set for a vote by Congress on the controversial agreement.
A broken bolt appears to have been the cause of the most recent fiery oil train crash in the Northwest. State of Oregon transportation officials are concerned increased traffic of heavier oil trains are adding undue stress to the tracks. The potential for another derailment has raised the ire of many in the region who are fearful of another catastrophic fire, explosion, or oil spill that could foul the nearby Columbia River. Paul Yeager explains.
Over the past decade, 27 oil trains and 11 ethanol trains have derailed in the U.S. and Canada, with nearly half of the accidents occurring in just the last 2 years. The latest incident happened nearly 2 weeks ago when 16 units of a 96-car train derailed near Mosier, Oregon. Nearly 100 people who lived within a quarter-mile radius of the tracks were evacuated. While no one was injured, the 42,000-gallon spill forced the shutdown of the municipality's water and sewer systems. Local leaders in Oregon and Washington are pushing their governors to put pressure on Congress for legislation that permanently ends all oil transportation by rail through the Pacific Northwest. Oregon Governor Kate Brown is already lobbying lawmakers, saying, quote, "I will continue to push the U.S. Department of Transportation and other federal authorities to take action that puts fewer Oregonians at risk of a dangerous crash in their backyards." Washington's Governor Jay Inslee has already spoken with Union Pacific and Burlington Northern leaders, asking them to slow trains down, use electronic brakes, and speed up the phase-out of older cars. For Market to Market, I'm Paul Yeager.
According to USDA, the number of dairy farms has steadily declined over the past 40 years. Rising costs force smaller and medium-sized operators to face the tough decision of cashing in their chips or doubling down on the future. And as producer Delaney Howell discovered, one dairy farm made a decision to go all in on an unconventional business plan that brought on more employees, opened the front door to guests, and appealed to those with memories of milk bottles clinking together as they went into the home delivery cooler.
Home delivery used to be all in a day's work for milk processors in the United States. While the practice has pretty much fallen out of favor, the service has become the key to the survival of a century-old Missouri family farm.
My dad had 3 girls. How unfortunate, I guess. But he taught all of us girls to take care of the cows, milk the cows. He said girls could do anything guys could do.
In the mid-1980s, the farm, now known as Chateau Dairy, was at a crossroads. Milk prices were too low to make a profit, and a decision had to be made on whether the Osborne, Missouri farm should be sold. Barb and Leroy Chateau eventually came to the conclusion the best way to turn a profit was to take out the middleman between the bulk tank and the table.
We came up with the idea to actually sell directly to the consumer and build a bottling plant here on site, a bottling plant, a cheese and butter room. So we approached grocery stores in St. Joe and Kansas City and actually finally got them to buy into the idea of having a local family farm deliver milk, farm fresh milk to their stores in glass bottles.
Unlike many larger-scale dairies, the Chateaus approach milk production in a more traditional manner.
Instead of using hormone to make them produce more milk, we did the other side of feed and pedigree of the cows to produce more milk, just more on the natural side of it.
Milking is a round-the-clock operation done in 2 to 3 shifts by 11 of their 48 employees. The crew starts at 2 a.m. and finishes at 2 p.m. every day. One of the keys to their success has been the use of glass bottles. The nostalgia factor, along with increasing shelf life to 17 days, has helped bring customers through the door.
In the glass bottle, you don't pick up the plastic taste. You can recycle the bottle, and most importantly, glass keeps milk colder. And milk lasts longer when it's very cold and kept like 36, 37 degrees.
Getting customers turned out to be easier than the Chateaus imagined. They began with a mom-and-pop approach to marketing and soon found word of mouth to be all the advertising they needed.
So it was all an educational thing, and we realized people wanted to come to the farm. So then we started doing tours at a very small scale, and now we see about 190,000 people through every year.
Originally, the dairy offered white, chocolate, and strawberry milk. Now, the Chateau Milk Company produces 8 varieties of milk and, depending on the day, puts up to 6,000 gallons of cold, fresh, hormone-free milk into 10,000 bottles. The company has 4 varieties of ice cream, 3 butter options, and 3 different types of cheese curds. Holidays and special events also bring unique flavors to Chateau, including a bright blue French vanilla milk to honor the 2016 opening day for the Kansas City Royals baseball team. The products are sold in the Chateau Milk Store on site and at 75 to 80 local Missouri grocers, coffee shops, and restaurants, as far north as St. Joseph and as far south as the Kansas City metropolitan area. In October of 2015, the Chateaus decided to embark on another project and started delivery directly to the doorsteps of customers in Kansas City and the surrounding suburbs under the name Chateau Home. Leroy and Barb's son Matt quit his corporate job after nearly a decade and returned to the farm to start the new division.
We've had customers asking for the milkman to come back to Kansas City for about 7 years, and all throughout the time we thought, you know what, number one, we don't have enough product, number two, we don't have enough time to do something new, right? As we talked about it and we did research, we were prepared to start it at any given moment. When I came back, I thought, you know what a great opportunity to both build on the brand that we've already created with Chateau Milk Company and also provide our customers with something that they've been asking for a very long time.
The return of the old-fashioned milkman has been good for business in many ways.
The Baseline company is about the idea of nostalgia and bringing back what was once, in vogue. These delivery trucks and a milkman says nothing more than that. It talks about a time in which things were much more simple, and when you had a milkman that whistled as he went down the street and got to know every neighbor that he delivered milk to. And so we thought that was just a Baseline good extension of our normal brand.
And the milkmen get additional benefits that go beyond completing a daily task.
I actually thoroughly enjoy meeting the customers. Even though I'm here early in the morning, every now and again I do get the rare occasion to meet a customer. I have a couple routes where the kids come out and they actually like giving me hugs. I don't know, maybe it's a thing, hugging the milkman. I talk with my grandparents. They always remember the milkman coming. Even my in-laws and my parents, they remember their parents talking about the milkman. So it is kind of fun to kind of bring back those memories for everybody.
The Chateaus began with a pilot program in October of 2015. But after some 5,000 customers registered, they decided to go full steam ahead. Chateau's 2 home delivery trucks are only able to reach about 15% of the 5,000 customers demanding their products, but plan to expand soon. Along with dairy, Chateau Home offers nearly 300 products from local Kansas City entrepreneurs.
We thought we would have about 10 to 15 suppliers. We now have about 20 to 25. We test them for quality. We want to make sure that we have the top of category. They're all exclusive to us from a home delivery standpoint. And I don't know, we feel like it's a great opportunity to really promote local and to kind of debunk this conversation that local is 250 miles away.
The Chateaus are continually looking for ways to upgrade their products. They have entered numerous contests and received various awards. The couple uses the judges' feedback to help improve the quality of their family-focused brand.
We just found out that our butter was one of the top 10 in the world. We also were the small business of Missouri about 5 or 6 years ago and got to go to Washington and found out we were one of the top 3 in the country. So we do enter because we want to see how we stack up to our competitors and other people so we can learn and get feedback and make things better.
Ultimately, all members of the Chateau family agree there is one element they can identify as the key to their continued success.
Our story is being local, providing a yummy milk for kids and adults. We want milk to be fun for people, not just something that your mom makes you drink when you're growing up.
For Market to Market, I'm Delaney Howell.
Next, the Market to Market Report.
A cheaper dollar, the possibility of Britain leaving the European Union, and good weather across the grain belt made for mixed results in the commodity markets. For the week, the July wheat contract lost 14 cents, while the nearby corn contract gained 15 cents. The possibility of near-term hot and dry weather sparked a late-week rally, but failed to keep July soybeans from losing 19 cents. July meal had its second week of losses, dropping $6.60 per ton. In the softs, July cotton lost 18 cents per hundredweight. Over in the dairy parlor, July Class 3 milk futures added 36 cents. In the livestock sector, the August cattle contract lost $4.80. Feeders took it on the chin, falling $8.13, and the July lean hog contract packed on 47 cents. In the currency markets, the U.S. dollar index dropped 22 points. July crude fell $1.09 per barrel. August COMEX gold gained $18.90 per ounce, and the Goldman Sachs commodity index shed just over 2 points to finish the week at 377.15. Here now to lend us his insight on these and other trends is one of our regular market analysts, Don Roose. Welcome back, Don.
Thank you, Mike.
Boy, let's talk wheat first. We've got the wheat harvest getting underway. They're finally dried out enough in parts of Texas to get those combines rolling. What have we heard so far?
Well, I think the one thing about the wheat market, that's one that solidly still is in a supply bear market. Harvest now is far enough along that it looks like we're going to have record yields across a lot of the wheat area. On the harvest front, the spring wheat area with a ring of fire with the heat dome, we're continuing to get some big moisture up there. World supplies are large. It looks like the Black Sea harvest is going to start to pick up here pretty quick. And even the French and German, where they had a lot of rain, that quality is probably better than we think. So ending stocks, bottom line, 550 million this next year over last year. Our stocks to use ratio in the U.S. About 50%, over a billion bushel carryout. Funds are short, but maintaining a mild short as the corn and soybean markets remain firm.
Okay, so producers looking into this market with that level of carryout, 15 cents down on the week, just pull the trigger and get it sold before we harvest even more record crop?
Well, if you haven't sold the wheat by now, the one thing they have on the wheat, you're talking basis levels down some of these areas, 75 to a buck under. You're talking a carry, full carry on the wheat almost. So if you can tuck it away, hedge it, try and return, get a storage return. And I think that's probably what the goal of the market is, to keep some of the wheat off the market, move the rest of the wheat, excess wheat into the feed channels to kind of buffer some of the tighter supplies that we might have on corn. But, it doesn't look like at harvest a marketing opportunity, Mike, really. Downside, probably if the corn market eases back, probably 20, 30 cents down, probably bottom more like in the beginning of July.
Okay. Now, as we see this corn market perhaps continue to have strength, is wheat going to be the unlucky one on the end of a lot of spread trading, buying corn, selling wheat?
Well, we've reached that point. I mean, you have wheat now under corn in some areas down in south, so wheat feeding's taking place. But it's really all about the wheat, watching what happens to the corn and soybeans for a real direction. There's no bull story on the wheat market in the U.S. or the world, but it's really a focus on what happens with the weather.
Okay. Well, now let's talk corn market, up 14 cents on the week. The chatter is happening. 450 corn, D's corn on the board. We've been there, or we're close to it. Are we going to crest and go over 450?
Well, I tell you, Mike, where you're really at in the corn market, in the grain market in general, you're in a weather market. And so far what we have is this high pressure ridge down in the southwest, and it keeps moving back, but back into the corn belt again. And it's a concerning pattern. It's one that probably crop condition ratings probably go down 2 to 4% on corn and soybeans this next week. So you're as good as the next weather forecast. You certainly have risk premium in the market, probably $1 or so. But if you look at it, this is how much premium we've got dialed in from December to July. The carry on corn's only 6 cents. You're not going to carry corn for 6 cents for 7 months. So that just tells you there's a lot of premium in. We might need it, we might not. Sunday night's going to be an interesting night because the forecast, we went home on Friday thinking we were going to have some hot, dry forecasts here for the next 10 days. If we do, we probably tack on more premium again next week. If we don't, we start to take some risk premium out. But it's all about weather. You're as good as the next weather forecast.
That being said, given that there is a lot of weather unease out in the countryside, in addition to in the market, how aggressive should producers be marketing that new crop in here under or near 450?
Well, 450, 460 is definitely a tough upside target. This is resistance. Remember last year, put it in perspective, with a shorter crop, but due to wet weather, we went to 454 and a half. We stopped. We eventually went back down to 360. And that's where we're at right now. You've got gap targets above the market, all the way up to 525 and a quarter. But first it's 350 and a half, and then it's about 10, 15 cent levels all the way up. We left gaps when we were torpedoing down from the bigger supplies. Now we're not certain, what kind of supply we have. So far, we really haven't lost a bushel yet, Mike. So it's all talk. It's all what could happen. The funds, are loaded on the soybeans and to a mild amount on corn, banking on some weather problems. We'll see. These are tough markets. I've been in the weather market since the 70s, and we're here again. And so you're going to live forecast to forecast.
All right. Now, before we get to talking about soybeans, we've got a question from one of our followers on Twitter. This one came in from Mary at Mary Johnson 0944 on Twitter. She's asking, what is happening with ag products in South America? Big, broad question. Let's talk second crop corn and what we're seeing with beans.
Yeah, and those are good questions, and it's amazing. First on the soybeans, by now we'd pretty well have it solidified what was the size of the crop in South America on beans and in Argentina. We're still trying to decide that, very late, quite surprising. I think we've kind of satisfied that we're probably sit someplace on that Brazil soybean crop, probably around 97 million, 96 million metric tons. The corn, much the same. I think we're starting to realize that we probably have a corn crop, somewhere in that 76 million metric tons. We're about 35% harvested on the Argentine corn crop because we're coming down. We're very tight supplies in Brazil on corn, and we need the crop to kind of satisfy that tightness. But we're going to run into world competition from Brazil and Argentina as we go forward deeper into the month of July.
Okay, now let's talk soybeans. 19 cents down, had a big correction this week. Monday through Thursday, sell off every single day. Friday turned it around. Both old and new crop soybeans. What does that tell you as we look towards next week?
Well, what it really tells you, we're still in the weather market. We put premium back on the market because the market was very concerned with the weather. Again, we had a hot, dry forecast overnight into the weekend, so we'll see if we need it. We top out usually in the most bullish news. Is this the most bullish news that you see? That's the question mark. Technically, our stuff turned down negative the end of the week for the first time since mid-March on the soybeans, still in a positive trend on corn, but a negative trend on wheat. So when you look at the soybeans, it's one that a lot of bull news dialed in. Much like the corn, if you look at the spreads from a producer standpoint, you've got November beans sitting 60 cents inverted over next July. You're not going to carry soybeans for 8 months for a negative 60 cents. So that tells you how much premium's in. The goal of the market is eventually sell the soybeans in the upfront if we have a tight supply. Still don't know if we have a tight supply. The end of June, you're going to have the all-important acres report. That could be up 1.5. I think wouldn't be surprised if it's 3 million. There's another 140 million beans. So you get ease your tightness a little bit of a buffer. So it's going to be a dicey situation. You're going to have to be, again, watching the weather close and very close on some of the technical indicators. The funds are sitting just off their record long supply in soybeans.
Okay. Looking at this livestock market, cattle continue to get hammered. Live cattle down 480 this week. Cash trade significantly off. Where do we go from here?
Well, the futures market has been right. It's saying that the cash cattle market's going to fall apart, and it is. This last week, we dropped $5 to $8 a hundredweight, $7 to $15 dressed. I think what we really have is a market, if you look at it, Mike, and we've looked at this before, we've talked about it, but you're in an overall supply bear market in the cattle. The cattle market wants to move to the downside, but it's a stair step down. It's trying to get more in relationship to what the corn or the cattle hog ratio is. But your real question is, where do the cattle go? Short term, seasonally, there's a strong tendency for the market to rally right during this time frame a little bit, but you have to be careful because when we get into the summer months, deeper into the summer, the demand is less. Third quarter supplies are going to be almost 6% over a year ago. Fourth quarter supplies are going to be 4% over a year ago, 4% more beef than a year ago. So it's going to be, the demand is going to have to pick up to absorb it. Have hot temperatures, demand kind of suffers a bit. So
yeah. Tough to get out and grill when it's 100 degrees.
It is. The good news on the East Coast, where the big population base is, at least there it looks like temperature's cooler.
Okay. Feeder cattle, $8 down, new contract low. Are we setting ourselves up for a drop down into the low 130s?
Well, the feeder cattle are trying to price in some of the corn dry drought problem. That's the issue. Where corn goes partly going to be dependent on where the feeder cattle go. But there again, like the cattle, I think long term, at least from our perspective, we're not overall bullish on the feeder cattle. But, these markets, they seesaw back and forth, and we're probably down at the lower end of the range, due for some kind of a rally. We think rallies in the feeders and fats are risk management opportunities, and keep your eye on the sky, keep your eye on on the corn market.
Risk management opportunities all the way out through next spring. How aggressive would you be on the feeder cattle side?
Well, I think when you look at it, look at the fat cattle for next August. We got down into the 103.50 for August the 17th, so that certainly tells you what you can pay for feeder cattle as you go out. So if that's what you have for fat cattle as you're going out, you have a sinking price. And if you have corn trying to rally, you need lower feeder cattle prices.
All right. Lean hogs. In contradiction to all of this bearish cattle news, lean hogs put on another gain this week. What's the top end on that market?
Yeah, and that's the good news on the meat sector, is that the hog market's quite a surprise. We think we might have been at the top end of the range. We've had an awful lot of managed funds in buying the hog market. We pushed up into new contract highs. Midweek on Wednesday, August had a key reversal off the $90 area, over 90 and then back under. And so you've got a key reversal says technically that you're either put in a major top or at least an intermediate top. Hog and pig report next week, and that's going to be key. We're well over the prices that the government has for projections all the way into the first quarter of next year, so take a look at your risk management.
What are you anticipating on that hogs and pigs report? Do you have numbers in mind that you expect already?
Well, we haven't put our numbers out yet, but we're working on them, and we think our farrowing numbers are going to be up just slightly. So we look for numbers slightly larger than a year ago. The good news on the hogs is that China, the hog producer over there is making about $200 a head, so that's why the imports have grown so rapidly, and that's why the funds are in the market trying to support the hogs.
Capture some of that export business and see this thing climb a little higher, maybe.
Exactly, but it's all good until it ends.
All right. Well, Don Roose, thank you so much for joining us this week.
Thank you, Mike.
That wraps up the broadcast portion of Market to Market, but Don and I will keep the market conversation going, including answering more of your questions during Market Plus, available on our website. While you're there, check out Market to Market Classroom. It's the place where students of all ages can find stories on the business, technology, and science of agriculture. And join us again next week when we'll ride along with a legendary full-service cattle buyer. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.